Right, you won't have to worry, because you can probably afford this.
The amount of that $300.
But, so what I want to propose to you guys is that there really are three reasons that a bank could ever face this problem. Okay? And this is entirely off book.
Like a king.
So, one reason is that they have a fundamentally unsound business model.
You're gonna list reasons?
I already am. So, one reason that a bank might not have enough money to pay what's due is because it's doing it all wrong. Okay, and we'll go over exactly what that means.
They went to Vaterac.
That's right, I teach you
Took
tech.
the free laptop.
Look on the bright side, at least I got a free laptop. Another reason that this could happen is because, which one will we go with first? Okay. Expected revenues exceeded actual revenues. So the bank thought it was going to get this much this quarter, and so it thought it would be able to pay the liabilities that are coming to maturity. But actually, the bank was wrong, and they only got that much, which was much lower than this much. So the bank cannot pay its maturing liabilities, right? Which gets us to the last point here is expected, we'll say, outflows. We can say inflows here for consistency. It's just money coming in. Expected outflows were less than actual outflows. Oops. Okay. Now, once we have these three potential reasons why a bank would face this situation, these reasons, I submit to you, can be decomposed themselves into economic factors and mismanagement, or bank-specific factors. Okay, what does this mean? So, why could the bank have a fundamentally unsound business model for economic factors? Well, one reason is, let's say you're a town with 3 banks in it, and the other 2 banks start adopting mobile platforms, and they start having online banking, and consumers catch on. But this bank was a holdout and decided, no, cell phones are a fad. We're not going to need to do mobile banking. Well, as their customer base demands mobile banking more and more, they're going to shift to the other banks. This bank's going to lose customers, and it's going to fail, basically, to run out of money because it had a fundamentally unsound business model. They had a business model that said, we don't need to provide our customers with online banking. Turns out they did. So, in contrast, they could also have a fundamentally unsound business model for mismanagement. Let's say the bank has this policy to buy every teller an Escalade. That's mismanagement. That's
Not from the teller's point.
not from the teller's perspective.
I'm sorry, the first one was fundamentally unsound business model from an economic factor?
Yes, so the economic factors were that...
Technology.
Yes, exactly, technology, times are changing, right?
Okay.
Or another case in point might be non-interest income, because during, as we'll hopefully get to, during the Great Recession, interest rates plummeted, and that squeezed net interest margins, so banks couldn't make money. So those banks that didn't quickly adapt to increasing their revenues from non-interest income sources failed. They couldn't compete. Mario, do you have a question?
No.
Okay. So, yes. Expected inflows exceed actual inflows.
Revenue.
Revenues.
Expected
Wait.
revenue.
No, yeah, no, that's right, okay. So you expect more money than you actually got in, right? Why would that be the case? That could be the case for economic factors. Let's say you gave a bunch of loans that were reasonably good, and all of a sudden, again, the Great Recession happens. Everyone loses their job, mortgages all start failing, and half your loan portfolio is in default. You didn't necessarily do anything wrong, it was the economy. But it can also be from mismanagement. You could have been greedy. You could have been given the marginal borrowers who didn't deserve credit. You could have been given them credit, and that'll come back and bite you. So that is mismanagement. So you expected more money to come in. You expected all these guys would be able to pay you, but turns out some of them are going default. You're not getting as much revenue as you expected. Okay? And last one is expected outflows were less than actual outflows. So you expected to have to pay out less in the current period than you were forced to pay out. So this would happen for economic reasons if there were a bank run. You didn't necessarily do anything wrong, but the U.S. financial sector is, going to hell in a handbasket. So everyone's jumping for the bank to withdraw their money. You couldn't have necessarily foreseen that, but you will have to meet a lot of outflows. And if you don't have the cash to meet that, you're in this situation, okay? For economic factors. Likewise, it could occur for mismanagement. You could have been too greedy again and deployed or optimistically said, well, we probably won't have 5% of depositors coming back and asking for us. Let's just fix the number to 3%. That means we have an extra money to lend, and that means we can make more money. And so when the number is actually 5%, then you're in trouble. Or you could have done a really poor job at trying to estimate how much deposit outflows there will be.
That sounds better, because the first one sounded fraudulent.
Fraudulent?
Like, you
Yeah,
said-
no, there's nothing fraudulent about that. It's business discretion. You can do that all the time. You have to prove that it's fraudulent. That's what's hard about fraud, is you have to prove that this was so far off the actual estimate that you can't invoke the business judgment rule. That manager can always say, well, number looked reasonable to me at the time. Can you say what's that?
Like, I thought that was right.
Yeah, exactly. That's what happens in practice. In super obscene cases that obviously won't happen, but those are the minority. Okay, so we've covered what the main risk is. We've covered how this risk decomposes, and we've covered that it can be because something is wrong in the economy, or it can be because something is wrong with bank management. Now let me show you guys how to assess a bank or how risky that bank is. So, in the literature and in regulatory circles and in banking circles, you'll hear this acronym tossed around very often. CAMELS. CAMELS. Are you surprised?
We started with camels now. First we started with horses.
I think you like camels better than you like horses.
So the C in
We'll
Kings
see.
is actually King.
Yeah. Good catch. No, actually, was that actually? Yeah, it was.
It's like, wow.
You're on a roll,
Okay. You guys bought it, huh? Capital, assets, management, earnings, liquidity, and this was only added in 1996. It was a mouthful. Sensitivity to market risk. And for
Hey, cameraman, can you lower that just a little?
Mm-hmm.
so
Surprised you got that much memory.
more than I have.
64 gigabytes.
So sensitivity to market risk for 90+% of banks is basically interest rate risk. And this is the least important kind and the most confusing kind, but the most interesting kind, so I really want to tell you guys about it, but I'm afraid I won't have time, but we'll try. So, if you think back to the three categories, the first one was the three reasons why you would face financial risk. The first one was fundamentally unsound business model. Okay? Where this factors in is earnings. Okay? If you're not making enough earnings, then you have a fundamentally unsound business model. What this means is one of several things. So one, you could be charging too little on assets. You could be paying too much on liabilities, or you could just be wasteful.
Charging too little to assets.
Paying too much on liabilities, or buying all your teller's Escalades.
How about charging too much and losing customers?
Yeah, that's another fundamentally unsound business model. That makes sense. I buy that. Basically, these are examples of it. So
I
you
just
get
figured
another
after I
example,
said
yeah.
it, I was like, I guess those are just examples.
Right. These are the most intuitive ones, but you can any other example that you would have that would fit this description works for any purposes in this class, or more importantly, your analysis. Okay, but as we can tell, management also factors into here, because you can do this accidentally, or you can do this because you're dumb and you just charge too little where you could have charged more. You have bad business sense, bad business judgment.
So management is part of that too?
What I'll demonstrate is management really affects everything. This is really key here. But where you see this flow through primarily is through earnings, right? If you have consistently bad earnings, that's a sign that you have an unsound business model. Why you have bad earnings, it could be that it's the economy, or it could be that you're mismanaging. Do you have a question, Mark? No, sorry. I keep wanting you to ask a question. Okay, so we're good on the first one. Next one we said was expected inflows are less than actual inflows, right? So, yes. Yeah, you expected more money than you actually got. Yeah. So why could this happen? This has to do with asset risk. How much risk is in your asset portfolio? Let's say you expected that all your all your borrowers would pay you on time, but as it actually happened, they didn't. A lot of them went default. So you expected more inflows than you actually got. And that's because you had risk in your asset portfolio. Another example of risk in your asset portfolio is securities. Let's say you invested in, it was really popular for banks to invest in trust preferred securities in 2006, 2007, a whole nother thing, but they almost all went default. They were really, really low class borrowings. So everyone got paid out before them. So banks took huge losses on those kind of securities. So it was in their asset portfolio, it was in their loan portfolio, which is part of their asset portfolio. I'm sorry, it was in their securities portfolio, which is part of their asset portfolio. And they just made bad choices on what securities they bought. They thought that these would be more promising securities, but they turned out not paying off anything. They had to take huge losses on them. I think the payouts were like 15 cents on the dollar or something on average. So that basically covers asset risk. So we've got 1, 2. And note again that this could be just the economy going bad, or it could be mismanagement. It could be that management intentionally bought crappy securities because they hoped that those securities would, pay off really high yields, but turns out they got bitterly disappointed.
So the biggest asset risk then, you would say, is buying bad securities?
No, biggest asset risk is loans, loan default. Yeah, so that, yeah, that's sort of the most important. Typically, default ratios are less than 1%, and in banks that are failing, they're as high as 5 to 10%. A bank that's in trouble of failing is probably around the 2 or 3%.
You said loan defaults are the most asset risk.
So the most, the part, how do I say this? The specific risk in the asset portfolio that banks face the most are the risk of loans going default.
Risk management, you say that buy risky securities?
Yeah.
Okay.
Now that's an example of it, right? But just in general, you know what mismanagement is. You know what making bad decisions is. Well, not you personally. You might have never made some. I know what making bad decisions is. So you could extend that to
So what are your 3 bullets there for?
nothing. They are for basically when you expect more money than you actually got. That happens when your assets don't pay off. Your assets don't pay off when you have to take large losses on securities that you bought, or when you have to, or when you thought that more of your loan customers are going to pay than they actually did pay. Does that make sense, Crystal? Yes? No? Okay. Does that make sense, everyone else? Okay. Then we get interesting one. Expected outflow was lower than actual outflow. Okay? So this happens basically when you don't have enough liquidity. And again, just like any other one, you not having enough liquidity could be a factor of management making poor decisions, or it could be a factor of actual economic phenomenon, okay? So let's do an important example here. Which of these deposits do you have to worry about running off the most if you're a bank manager, okay? We have several different, I won't just limit it to deposits, I'll limit it to a few different liabilities. We have checking accounts, we have a CD, and in case you guys don't know, CDs stand for certificates of deposit, and it's basically a contract to keep your money in the bank for a certain amount of time. You can get anywhere from a 1-month CD to a 10-year CD. Maybe you can even get more, but I haven't seen more. And so what that is basically you saying that bank, every quarter or year, you'll have to pay me this much interest for the next 5 years, let's say, if you have a 5-year CD. But in exchange for that promise, I'm going to keep this money at your institution. I have the power to unilaterally break my promise. I say, well, I told you I'm going to give you this money for 5 years, but I'm actually going to take it out in 3 years. But the bank can give me a penalty for breaking the promise. So I'll never actually lose money, but if I was earning 3% interest, I might not get my last year's interest payment, or I might have to pay that back to them. So that's what a CD is. And then let's say we have a other borrowing. Let's say the bank went out to the bond market and issued a 10-year bond. Okay? So which of these accounts, or which of these types of liabilities pose the most liquidity risk to the bank? You guys understand that statement? Checking account. Why is that?
Because there's the ones with no ties to promises to keep it in the bank for as long
Exactly.
as whatever.
Anyone can legally go into a bank and withdraw all or 1% of their checking account or anything in between at any given point, day and night. So this is money that can leave the bank easily. Consider this though. What if we subdivide CDs into small and jumbo.
Jumbo,
Which is gonna be riskier, jumbo? Why is that?
more money?
More money, and these depositors are more sensitive to different economic conditions. So I can have $100,000 in the bank and not look at the bank's balance sheet or income statement at all the whole time I invest that money with them, or I lend that money to them. But a person who has $1 million in a bank account stands to lose $750,000 if that bank fails. They're going to be monitoring the bank. And if the bank is about to go under, I probably won't see it at all because I'm not checking the bank's books. But that guy probably will and should if he's smart. So he's going to take his money out. Versus the small CD guy might not necessarily take the money
So
out.
you said checking accounts are the most,
Checking accounts pose the most liquidity risk for the bank. And the liquidity risk is basically not having enough liquidity to match outflows. Okay? Other borrowings, you don't have to worry about them. It's not like the bond market can knock on your door early and say, hey, you promised to pay us this note in 10 years, but we want it now. Well, sorry. It's due in 10 years. I'll give you $1,000 in 10 years, and I'll give you whatever coupon payments I promised you till then. So these don't pose much of a liquidity risk. Bless you. So, bless you. Get there. Okay. But as we had established before, well, before I make that statement, let's do one other exercise. Is I can phrase risk one of two ways. I can say that the bank has too much risk given a level of risk protection. Or I can say that a bank has too small risk protection given a level of risk. Do we understand that these are basically two ways of saying the same thing?
How much risk given?
So if we hold the risk protection constant, then we can say that the bank has too much risk for this level of risk protection. And we haven't exactly gotten into what risk protection is, but it'll make sense in a second. Conversely,
Too much
Jay?
risk from what perspective?
So from the perspective for the bank, let's say you have an insurance policy, right? And let's say you have fire insurance policy on your business, right? That insurance policy is going to pay out $100,000 if your business burns down, right? If all you do is light an occasional cigarette inside, you have probably a safe amount of risk given the level of risk protection, okay? If instead you're a pyromaniac and shoot fireworks off inside, then you have too high level of risk given that risk protection. If you wanted to, you're almost certainly going to lose that money. So if you wanted to entertain that kind of risk, you might want to up your insurance premiums so that you'll get $250,000 or $1 million in case the building burns down. Does that make sense? Conversely, you can say you have too little risk protection given a level of risk. If I'm a pyromaniac and shooting off fireworks inside, I should probably have a higher insurance policy than just what it's gonna cost me to replace 3 doors and a window. Okay. Yes. So what we have covered is how these three that are checked relate to taking too much risk, given a level of risk protection. The other side of the coin has to do with capital. Capital is how a bank protects themselves against the risks that they take. So, if you have a bank that specializes in lending to high-risk borrowers, so what do they call them? Alt-A loans or subprime mortgages, they have a lot more risk in their loan portfolio than a bank that only deals with top grade borrowers. We had one financial institution, Boston Private, that in order to be a client, you had to have a minimum net worth of $3 million.
Nice.
So those people aren't going to give subprime loans, right? Boston Private wouldn't give subprime loans. So it doesn't matter as much for them, at least from the asset risk perspective, how much capital they hold, because it's much less likely that they will burn through all their cash, burn through all their securities, until the losses start eating into the equity buffer, the capital buffer. So it's much more likely that the bank in inner city Detroit that deals with primarily high-risk borrowers is going to have to cash in on some of their capital. And to compensate them for that, they need to keep higher capital reserves, just inherent to their business model. Okay? So capital is going to be a way that you protect yourself against risk, because they have much higher expected losses than Boston Private. So they have much more expected risk, right? They have much more risk, not expected risk. They have much more risk in their loan portfolio. So to protect themselves against that risk, they're going to have to hold much higher capital levels. Did that make sense? Okay. With the remaining 7 minutes,
Quick thing, did you say assets through liquidity went with too much risk given? So all of
yeah,
those-
assets, earnings,
Yeah.
and liquidity, yeah. We're basically, we were just, it's not important, the arrows, but what I was trying to emphasize is we had been talking about how banks might be taking too much risk. They might be taking too much risk by giving bad loans, by not keeping enough liquidity, by having a bad business model, by having bad management, which affects any of those. But now we're going to talk about, now we've talked about how banks might not protect themselves adequately against the risk. And that would be by keeping too low of a capital buffer.
That would be part of, oh, no. That wouldn't be part of management risk too?
That also counts as management, because management ultimately sets capital, or at least to begin with. So yeah, management affects that too. So this component really affects everything. The one component we haven't talked about is sensitivity to market risk. And I just give you the full name because that's the S in camels, but really what this means is interest rate risk. Okay, and the easiest way to see that is to go over a couple examples. And this is important to understand. So if I happen to run over by 5 minutes, if I can borrow 5 minutes from you, I swear I'll pay it back to you next class.
With interest?
With interest, yep. Okay, so
This one's talking about for you risk.
let's say you're a bank and,
High risk.
okay. So this was the most interesting thing about being a bank examiner, by the way, because this is all the numbers here. So for simplification purposes, let's assume you have no equity, just because that makes the numbers that much harder. Let's say all you do is borrow money from people and pay that exact sum out to people who borrow money from you, okay? So let's say you have 100 million in mortgages, okay? And these mortgages are 15-year fixed rate mortgages, and they pay you 8% a year, okay? You funded all of these mortgages with CDs. Funded them with 2-year CDs. So, and these CDs pay 2%. Okay? Further, let's assume that operating costs are equal to 5% of total assets. Okay? So we have all the information we need to calculate net income for this bank. Okay? What's net income going to be? What are their revenues going to be?
8% on 100 million?
8% on 100 million. That's what the revenues are going to be.
Oh, okay.
Sorry, yeah, no, I see where you're going, but so 8% of 100 million equals 8 million in revenue, minus interest income of 2% times 100 million equals 2 million. Just to emphasize, let's call this. So interest income of 8 million, interest expense of 2 million, and non-interest expense, that is operating costs, of 5% times 100 million equals 5 million. So we have $1 million in net income. Okay? Do we all see how we got there? Okay. Now, what happens when 2 years from now, interest rates spiked up? Okay? In fact, interest rates doubled. What's going to happen is that banks that are making new loans make new loans at a higher rate. And because they're doing that, they can afford to borrow at a higher rate. Does that make sense? So borrowing costs, or cost of funds, is going to increase. And it just so happens that in 2 years, these CDs have matured. So if the bank wants to continue funding its 15-year mortgage, they have to issue new CDs. But the new CDs they'll issue will be at a higher rate. So instead of paying 2% on their new CDs, if funding costs have doubled, they have to pay 4%. Okay? And so at that point, there's 13 years left on this mortgage, and let's say they issue CDs for 2 years instead of 3 or 4 years. Okay? What's going to happen? Interest income is going to stay the same. Bless you.
Spikes to 4, which they lose if they leave.
Exactly. This moves to 4, so we're at 4 million in interest expense. This stays at 5. Operating costs hasn't changed, and so we come out with negative 1 million in net income, or a net loss of 1 million. So without any equity, without any capital or any cash or securities, banks just going to have to close. They're going to have to liquidate their loan portfolio. What they could do is sell off, let's say, $20 million of their loan portfolio. They'd have to take a huge haircut on that and get